If you're a plumber, builder, electrician, or another tradesperson, and you've just become a limited company, then this video is for you. Going limited sounds very official. New company, new bank account, maybe you even feel like Alan Sugar for about 10 minutes. Then HMRC, VAT, payroll, and CIS enter the chat. I'm Abby from Clarent Accounting, and in this video I'm going to be going over 5 costly mistakes that tradespeople often make when setting up a limited company. Now for each one I'm going to be going over what the mistake is, why it can cost you money, and what to do instead. Because some of these mistakes are easy to avoid, but if you leave them too late, they can create tax problems, missed deadlines, and a lot of stress. And mistake number 1 is one of the biggest, so let's get into it. Mistake number 1 is treating the company money like it's your own. For example, using the company card for fuel, personal bills, random Amazon orders, or even the weekly food shop if things are tight. And I get why this happens, because maybe you've been self-employed for years, then gone limited, but you're still using the business account in the same way. Maybe you don't know how to properly pay yourself yet, so you keep putting it off. Or maybe you do understand it, but you just think, I'll sort it later. Either way, you see money in the company account and think, lovely, that's mine. Unfortunately, HMRC does not share that relaxed interpretation. The problem is, once that habit starts carrying over into your limited company, it can start costing you money. And here's why. Those withdrawals can build up as a director's overdrawn loan account. And in simple terms, that means you owe money back to the company. And if that loan is still outstanding 9 months after the end of the company's accounting period, the company can face something called a Section 455 tax charge. Yes, painful. So, as a simple example, if your director's loan account was overdrawn by £10,000, the company could face a tax charge of at least £3,375. Now, there are ways the company can usually claim relief later if the loan is repaid, released, or written off. But it can still cause cash flow problems, extra admin, possible interest fees, and a nasty surprise when the accounts are done. So here's what you can do to avoid this mess. First, remember that the company is a separate legal entity from you. That means the money in the company bank account belongs to the company. It is not automatically your personal money anymore. Annoying, I know. So instead of just taking money out whenever you need it, decide how you're going to pay yourself from the start. And normally directors pay themselves through a mix of salary and dividends. The salary is usually run through payroll, and dividends can then be paid from your company profits after corporation tax has been allowed for. Done properly, this can be very tax efficient. And in some situations, you may also use a properly recorded director's loan. But the key word there is properly recorded. What you want to avoid is taking money out randomly and hoping to sort it all out at the year end, because that's usually where the mess starts. This usually happens when someone sets up the company and thinks, right, that bit's done. I honestly wish it was that simple. And technically, yes, the company exists, but that does not mean the tax side is ready. Once your company is active, you need to know which taxes apply. Usually that means corporation tax, VAT if your taxable turnover goes over the VAT threshold, PAYE if you're paying yourself or staff through payroll, and CIS if you are a contractor using subcontractors. So the mistake is not just forgetting one form. It's not having a clear tax setup from the beginning. Now, the cost of not registering for the right taxes is not always one simple fixed penalty. HMRC can look at things like how much tax could have been lost, how late it was, whether it was careless or deliberate, and whether you told them first or they found it first. So the penalty can really depend on the situation. Basically, the later you leave it and the bigger the amount of tax that's involved, the more serious it can become. For example, with VAT, if you go over the registration threshold and do not register on time, HMRC can backdate the registration. And that means you could owe VAT from the date you should have registered, even if you didn't charge your customers VAT at the time. There may also be a failure to notify penalty, based on the tax HMRC thinks could have been lost. And with CIS, if you do not register or set it up properly, you can end up with missed deductions, missed returns, penalties, interest, and a messy HMRC bill to fix later. So the cost is not just the tax itself. It's the backdated bills, failure to notify penalties, late filing penalties, interest, stress, and time spent fixing something that could have been set up properly from the beginning. So here's what you should do instead. Do not just register the company and think the job is done. Instead, from the beginning, make sure you know what taxes apply to your business. And if you're not sure, try to get advice early, because it's much easier to set things up right from the start than to fix misregistrations and penalties later. Mistake number 3 is leaving insurance and the business basics set up until later. For example, not having a separate business bank account, proper records, a system for invoices and receipts, the right tax registrations, as we covered in the last mistake, or the right insurance. And this usually happens because these things don't feel urgent from the start. You are focused on getting jobs in, sending quotes, doing the work, and getting paid. Insurance, records, invoices, and systems can just feel like boring admin. And to be fair, no one starts a trades business because they're passionate about filing receipts. But these are the foundations that stop the business from becoming messy, risky, or hard to run later. So why it costs you? Public liability insurance is usually very important because it helps protect you if someone claims your work caused them injury or damage. And it's not automatically required just because your company's limited, but many customers, building sites, and main contractors will expect it. And realistically, if you are working in people's homes, on sites, or around other people's property, you do not want to be guessing on insurance. Because if something goes wrong and you're not properly covered, you could be dealing with the claim yourself, which could mean legal costs, compensation, repair costs, lost work, and a lot of stress. And that's not the exciting part of running a business, I know, but it is the part that protects you. And if you employ staff, you'll usually need employer's liability insurance. And that's there to protect you if an employee becomes ill or injured due to the work they do for you. And this one is legally required in many cases. And if you should have employer's liability insurance and you do not, the fines could be serious. For example, you could be fined $2,500 for every day you're not properly insured. So this is not just boring paperwork. It can affect whether you get work, whether you're protected, and whether you're meeting your legal responsibilities. So here's what to do instead. When you go limited, take a step back and make sure the business is set up properly, not just registered. And that means checking what cover you actually need. Public liability insurance in case someone claims your work caused injury or damage. Employer's liability insurance if you employ staff and need to protect the business if someone gets ill or injured because of the work. Tools insurance because if your tools are stolen, the jobs do not stop needing to be done. Van insurance, making sure it actually covers how you use the van for work. Contract works insurance if work in progress gets damaged before the job is finished. Or professional indemnity insurance if you give design, drawings, specifications, or professional advice. The exact cover depends on your trade, the type of work, and who you work for. So the point is not to guess and get the right basics in early. Mistake number 4 is not tracking expenses properly as you go. And for trades, this matters because there are a lot of costs. Tools, materials, van costs, fuel, workwear, insurance, phone, software, and subcontractors. The problem is not always that people can't claim things. The problem is that receipts go missing, payments are unclear, and nobody has a clean record. For example, you might look at a bank transaction from 8 months ago and it says something vague like BP, Amazon, Screwfix, or a card machine name you do not recognise. Or even worse, it just says card payment £74.20. Brilliant. Very helpful. Could be materials, could be fuel, could be lunch, could be anything. And your future self, looking back 5 months ago, is not going to have any idea what you paid for. I barely even remember what I got yesterday from Tesco. So let's go into why it costs you, and this is often where people get caught out. Because you can't just guess later and say, yeah, that was definitely for the business. And if you claim expenses or VAT without proper evidence, HMRC can challenge it. That could mean the expense gets removed, the VAT claim gets knocked off, your tax bill goes up, and in some cases, penalties can be added if HMRC thinks you have not taken reasonable care. And if someone knowingly makes things up, that can become a lot more serious. So this isn't just admin for the sake of admin. Bad records can cost you money. And this is where a lot of trades lose money on tax-deductible expenses. Not because the business didn't spend the money, but because the evidence isn't there to prove it when it's needed. So here's what to do instead. The best habit is to capture the receipt straight away. Take a photo as soon as you get it, while you still know what the transaction was for. You can use a tool like Dext alongside QuickBooks or Xero to capture receipts, match them to bank transactions, and keep evidence in one place. It also saves time later because your accountant isn't coming back months later asking, what was this transaction for? So the takeaway here is that if the receipt matters, take a picture and capture it straight away. This is one of the biggest mistakes. A lot of tradespeople treat accounting like it's something that happens only once a year. You finish the year, gather what you can, send it over, and just hope for the best. And year end is not the ideal time to become a detective. Receipts are missing, you can't remember what some payments were for, VAT may be guessed or dealt with late, CIS returns may have been missed, money may have been taken out of the company in the wrong way, and you might have no idea of your profit month to month. And this can cost you because at year end, it is often too late to fix things properly. If you have taken money out of the company in the wrong way, it might lead to extra tax, director's loan issues, or a messy accounts cleanup. And if your salary has not been planned and structured properly, you may have missed a more tax efficient way to pay yourself. If VAT or CIS has been dealt with late, there may be penalties, interest, or backdated bills. And if you don't know your profit month to month, you're making decisions without knowing your numbers. And this matters because good business decisions need up-to-date information. And if you're thinking about taking on subcontractors, hiring staff, buying a van, investing in tools, increasing your prices, or taking money out of the business, you need to know what your numbers actually look like. And not what you hope they look like, what they actually look like. Now, what you should do instead is keep your books updated monthly. That way you can see your profit and loss, plan for VAT and tax, know what you can safely take out, and spot problems before they become expensive. It can also help with tax planning, because some tax-saving decisions need to be made during the year, not at the year end. And from a cost point of view, it's usually cleaner to keep things updated monthly than to hand over a full year of messy records last minute. When everything is left until year end, the accountant is often just recording what already happened. But when things are kept up to date, they can help you plan properly. So the key takeaway is to not treat accounting like a once a year job. And set up a monthly plan early because it makes business life easier, and done right can save you a lot of money. So those are the 5 costly mistakes that tradespeople often make when setting up a limited company. So if you've just gone limited, or if you're thinking about it, getting these things right early can save you a lot of stress and money. And to make this easier, I've put together a free limited company setup checklist for tradespeople. It goes through the main things to check, including tax registrations, paying yourself, CIS, VAT, receipts, and monthly bookkeeping. So if you want to make sure that nothing gets missed, download the checklist using the link in the description. If you've got any questions, feel free to get in touch, and good luck, and I'll see you in the next one. Bye.